Okay. Hey, thanks for coming out this afternoon. We're looking forward to a great conversation. How many of you have actually been here to any of our events? Excellent. Well, we encourage more of you to kind of come out on a regular basis. We have these conversations on a regular schedule so that you can learn about how innovation works and how we can kind of connect the community to what we do here on campus, but also explore kind of the edges of where entrepreneurship and innovation is. This building, the Design and Innovation Building, is one of the gateways to the UCSD campus. It was originally designed so that we could be more connected to the community, and these conversations, these Meet the VC conversations, are just one of the ways we do that. We started these because sometimes getting to know local investors and figuring out how to reach them, pitch to them, conversations with them, it seems a bit difficult at times. And we wanted to do these conversations so that we could demystify the process. Because most people think, hey, I just start a company, I get into the point where I have a product, and I just will listen. And then they write me checks and I become rich and all's well. And of course, that's not the way it works. There's a lot more to it than that. And so we want to introduce you to a lot of flavors of investors, people who invest at different stages, with different themes, with different ideas of what a great business opportunity looks like. And so today we're fortunate to have with us Ryan Sommerville, one of the general partners of the Antler VC. I'll let him tell you more about not only his journey, but about Antler. But I had the pleasure of meeting Ryan and the team from Antler a few months ago, and we were quite excited as they kind of explore where they're going to place their offices here in California, but more importantly, the kinds of companies that they want access to, and we can introduce some of our entrepreneurs to them as well. And I see several people in the audience who are entrepreneurs that we work with, so we're excited to have you in here. These are meant to be conversations. We certainly can have conversations with Ryan and I. But if you have a question, please raise your hand because we want it to be for you. We want you to ask questions. We want you to be active. There are no silly questions because I can guarantee you the question that's probably on your mind is probably one that 2 or 3 other people in the same room are probably thinking as well. So please don't be bashful or shy. In fact, one of the kind of traits we look for in entrepreneurs are people who can speak up and ask for what they want. So at this point, I'm going to turn the microphone over to Ryan. I forgot to introduce myself. I'm Greg Horowitt. I'm the Director of Innovation Design for the Office of Innovation here at UC San Diego. And we do innovation and entrepreneurial programming here on the campus. We work across disciplines, across divisions. If you notice, this building is not part of the school. It sits at an intersection point between all of these disciplines. That is how companies are created. Companies are not necessarily putting either 3 MBAs together or 2 engineers or a couple of doctors together. It's about bringing an entire community together to build a company. So we're a perfect intersection place. We're also a wonderful place for you to get access to entrepreneurial resources. So we act as a concierge as well as a content provider and education programming. So come and take advantage of the various programs we do. We'll talk about more of those at the end of the conversation. But right now, I'd like to turn the conversation over to Ryan. If you could kind of tell us a little bit about who you are, kind of your journey here, and then tell us about Antler.
First and foremost, brilliant to be here. I've spent a fair amount of time at UCSD over the past several months as a reference. I think it's a unique situation you guys have here. I've worked with a number of universities for the past 5 years building Antler. This is one of the more collaborative and I think less bureaucratic organizations that I've had a chance to interact with. So kudos to you guys, and I have a great deal of respect for what you built here. Ryan Sommerville, I'm a general partner with Antler, as Greg mentioned. Antler is a global early stage VC. The problem that we're looking to solve is how do you institutionalize the family and friends round in order to catalyze innovation at the earliest stage. So we started the firm back in Singapore initially in 2018. We've since expanded the platform to 30 cities across the world. So it's been fairly rapid global expansion for us. And I think that's because we're solving a meaningful problem, which is that we need more entrepreneurs in the world. Too much talent is locked up at big or sitting behind a desk at Google or Facebook or sort of the corporation doing work that really isn't moving human civilization forward. These are highly talented individuals that otherwise can solve multiple problems for society, but they're sitting behind a desk. The issue that folks like that tend to face, I think it's true as well, for what it's worth, is they don't have access to family and friends capital. And taking the leap by yourself to go money to solve the problem is incredibly difficult, both in terms of the financing opportunity as well as in terms of just how lonely it is to build a company. The alternatives to something like Antler is building by yourself in a local coffee shop or attic or your garage and trying to source a co-founder on your own and validate your problem statement. It's incredibly difficult. So what Antler provides is the opportunity to do the early stage problem statement validation, discovery, building initial MVPs, commercialization, alongside a community of fellow founders working at a very similar stage. So again, started in Singapore, we just expanded it globally. I came on board as the first hire for the US. This was back in the summer of 2019. So that was in New York where we launched the US initially. Everyone who joins Antler in a respective region is essentially given a mandate, go and raise your own fund. Your region then starts to deploy into startups from new locations. So we started the US in 2019, launched in New York initially, ran our first program in the fall of that year, started to raise our fund. None of us had any idea what we were doing. We had never raised capital before. Almost every partner at Antler comes from an operator background. So my background is in early stage entrepreneurship in a number of ways. As a founder, as an early hire, I ran a nonprofit for years in New York that was focused on essentially pro bono services for local entrepreneurs prior to coming to Antler and then being an investor. But that story is fairly representative of the folks who are in the firm globally. So raised our first fund, that was $35 million, actually just servicing New York. Made our first investment in January 2020, so right before COVID broke out, particularly in the city. The intention was to come out to Southern California, launch the second location at that time, but COVID threw a wrench into that plan, particularly given the interest of what we do. So I went down to Austin, Texas to launch the second location in early 2021, and then Boulder, Colorado, which was the third one for the firm and where I'm technically based now, although I haven't been home since Christmas because we're going to launch a fourth round location in California. So it's back on the roadmap in a serious way. What we do in detail is we run these programs that are fairly analogous to an incubator or accelerator. So we run this pretty extensive scouting process. We had 130,000 people apply to Antler locally last year. We accept about 3% of total applicants into these programs. The programs are run in each city. For the US, it's Boulder, Austin, New York, again, all kind of running simultaneously. 75 to 100 founders per city. And these are folks that are, again, left their job a month ago, problem statement in their head, potentially nothing else, and they're focused on all the things that I mentioned around kind of validation, initial tech, and commercialization. And then we'll invest in these companies at the end of that process. So it's an 8-week-long program for the first phase. The first phase is focused on, one, creating a brilliant experience for all the founders who go through it. So there should be no downside to joining Antler. There's never a cost to participate. Secondly, as a VC, that's our opportunity to really underwrite founders. And we believe that gives us a considerable competitive advantage where most pre-seed funds who are investing in startups are seeing a company in a polished boardroom setting or more realistically nowadays on Zoom. They're investing based on the pitch deck and idea that sounds halfway decent. Our approach is that we're going to work in the trenches with our founders over the course of this 8-week period to make what we believe is a more informed decision. And that goes both ways. So we think that it's an opportunity for us from an underwriting perspective, but it's also an opportunity for the founders to get to know us, which is quite important because taking venture money is signing up a 10-year marriage and it's something to be taken quite soberly. Once we companies, it's not on standard terms that folks are interested in applying. So we invest about $200K for 9% of the businesses, so 2.75 post money cap on a stake. And then the folks that graduate into the second phase, i.e. receive the capital, are then a part of a 3.5-month long process that's about, hey, now you have some money in the bank, how do you essentially go and find your product market fit? So it's BD and growth support, it's building the next generation of technology, bringing on early executive hires is incredibly important and something that we're fairly uniquely positioned to help with given the scope of the network. And then it all culminates in a fundraising release where we're essentially taking our companies to market to raise downstream capital. And arguably, that's what Antler's best position to do. So once you kind of graduate, you go through this process, and then the idea is that you're raising this team kind of a 6-month process of coming in. We also follow on in our companies to a pretty meaningful degree. So the deal technically for us is we'll invest $250 for 9%, like I said, but then you get a second term sheet at the same time for an additional $250 to $500 that will convert at the terms of the seed round. And then lastly, we have a larger continuity fund that does Series A seed investing. So the long-term ambition of Antler, for what it's worth, is how do we catalyze innovation, but also be a financing resource partner for our companies from literally day zero when we get involved and support them throughout the whole life cycle of the venture.
Any questions? Were there any terms or things that you mentioned that you may not have understood? We're happy to clarify.
Sector agnostic. So 95% of our first fund, which again was that $35 million vehicle for the US, was in software, but agnostic across sectors. I think the best way to think about it is what do we not do? So I think that anything that's incredibly hardware intensive, this is more relevant for San Diego, anything that's super R&D intensive. So I'm not going to suggest that we're the best fit for a bio life sciences project. I think there are exceptions to that, or software platforms that interface with the life sciences apparatus is certainly within the wheelhouse. But if you're building a med device or a therapeutics company, I think that $250K probably isn't a sufficient catalyst to get you to the next stage, and that's worth consideration. But also, it's just a personal opinion that there are biotech funds out there for a reason, and I think it's a good reason. I always want to check the box that I can actually do a company for and support. I don't know a damn thing about it. Yeah, definitely. On the software side, for sure. So, I mean, there's a number of opportunities. There's obviously a hot space now, especially with the emergence of AI and discovery. So there's opportunities that I'm looking at in the portfolio as we speak. But it's always the software side.
So you said that something along the lines of like invest in people who maybe just had like a pop-up business started. So when people like that are applied to Antler, what kind of things are you looking for like application that show that they're processing?
Yeah, definitely. No, great question. I mean, to be clear, we're not investing in folks. They're just the problem statement stage. We're investing based on the momentum that they create over the so they're extended at the point of this problem statement. So what we're looking for at that stage and how we kind of refine that top 3%. What you can really underwrite at that stage is track record, necessary domain expertise, and then there's a number of questions you can ask to kind of test the grit and resiliency, which is critical to being a successful entrepreneur. So what I tend to look for, and I think there's a few different buckets that we're sourcing from. One is the kind of corporate environment that I referenced to previously. So to use the Google example again, was this someone who was a passenger at Google, or was it someone who actually drove something forward that was animated? And it doesn't take too many questions to get to the core of that. The second bucket would be folks who have relevant startup experience, but they were, let's say employee number 50 at like Uber or an Instagram pre-acquisition, something like that. They've seen hyperscale to some meaningful degree. They've been part of that journey, obviously, by nature of how early they were. They want to get into the driver's seat of building a company on it. So you're underwriting that track record, but also you can understand the motivations. And then the third bucket would be folks who have already taken the loop. So there is a bit of a spectrum in terms of people who get accepted to the program. I think the cutoff point would be someone who's up to 5 months maximum already starting to build their company. They haven't taken any institutional capital already, but they have a more kind of knowledgeable track record in terms of the actual business coming in the door with. But yeah, what you're really underwriting is, do they have the grit and resiliency? Are they really in this for the next 10 years? And do they understand the collateral damage that comes along with that? And then domain expertise is something that is important to understand. Is this a kind of product founder thing? In a sense, it's someone who really understands the space to the top 1% of the world degree which is necessary. And then, yeah, what have they proven now so far?
Can you walk us through your technical steps? What would be a successful entry to exit?
For the fund?
Yeah. So like from seed all the way to finish.
Yeah. So from a portfolio construction perspective for our fund, we're somewhat uniquely positioned, which is probably the motivation behind the question. We're more founder aligned than anyone can be, given the early stage that we come in. but it also affords us a pretty interesting exit opportunity where we don't have to hold our portfolio positions to the typical maturity that another VC would. So our model isn't predicated on having huge IPOs or Series E and beyond M&A activity. We start to de-risk our investors usually at kind of Series C to D level. So if you think about it in terms of the number of shots on goal that we're taking, so we'll have 225 positions in our next fund. You really only need about $3 billion in market cap, which sounds like a lot of money, but it's not in this game, to return the entire fund. You can start to achieve those outcomes at the Series C if you take 10% of your positions off at that point. So we have an interesting opportunity to sell in secondary markets once you can enter the Series D territory, which is quite core to the strategy. The reason why it's important for our investors, our LPs, is the liquidity lockup that they have by coming into our fund is going to be longer than the average venture fund, given how early stage we start. So you have to think about the liquidity timeline there, as well as the risk profile that we're taking. Good question.
What questions do you ask, or what things, or what body language do you try to read in founders to test for grades and between?
Yeah, body language is a tough one. Most of this stuff is done virtually in our application stage by necessity. Because although we're based in these 3 locations, we're sourcing founders from across the country, which is important to notice. Some of my favorite questions is, what's the most difficult thing that you've done, in your life? There's a hell of a lot that you can learn from that sort of question. And then you kind of just go through the track record and ask detailed, more curated questions based on what their experience was. So what was the most successful project you worked at when you were building X at Apple? And you kind of pry in accordingly. So I've gone to a place where I try to make it more bespoke. In the beginning, it was a little bit more advertising. And try to make it as much of a conversation as possible. You can learn a lot by having someone speak for a long period of time, which we might find out tonight.
Okay, good.
Okay, thank you so much. The question is, time is very important to go to the market. How long does it take for pre-seed startup to get the fund, and what about your ticket size for pre-seed startups?
Yeah, so again, it's programmatic. So we're running these programs twice a year. They're 8 weeks long. So you agree to come in and give us the option to invest at the beginning of the process, and you're super early stage at that point. And then within 8 weeks, you're getting a decision as to whether you're going to invest or not, and it's on set terms. So you know the terms coming in the door, and then have kind of 8 weeks before we make the decision, which is usually a collective decision as to whether we want to invest or not.
And the ticket size?
Yeah, so it's $250K for about 9% of the outset, and then additional follow-on capacity, which is dedicated up front to the tune of about $250 to $500. That's uncapped. That'll convert at the price of the subsequent event. I'll let you choose. Yeah, in the back, just because you already have it.
So when you say you're in the trenches, how diverse are you there?
Yeah, no, I think it's important to understand. So we're pretty heavily involved, right? So I think that when I ran the first program, my tendency probably gives you too much insight on my personality was to over-engineer what the actual program looked like. So every 30 minutes there was some kind of pre-scheduled event going on, whether it was like a speaker session or a happy hour or town hall or whatever it might be. That was a mistake in hindsight. The way that we run the programs now is really your heavy lifting that you're doing as an Antler partner is curating the highest quality community possible and then creating a sufficient amount of white space for the founders to go and create on their own. And the optionality that you're offering them is the opportunity to engage with the office hours, which is really where we can be the most useful. So the way that I think about it is 75% of the value of coming into the program is the founders to the right and the left of you. I'd love to tell a great story about how valuable I could be in a whiteboard session, and all of that is available, but the community is the predominant driver. The best founders in the world don't want to have me talk to them about business model 101, and typically they're beyond that stage when they enter the door. So, in the trenches means we're working actively on go-to-market strategy. We're working actively on tech. We're making introductions to development folks to join the team or potentially sell into and then eventually to VC. So it's a support role, but through that support role as a VC for anyone who's interested in that path, you also get a lot of data as we move back at the end of the process.
I like that.
Yeah, it's a tough one. So For the U.S., again, Antler is based in 30 cities across the world. There's a different answer depending on where they're based. Singapore is an example where we're able to actually issue these, which is super helpful. It's not so easy in this country, unfortunately. So we have a lot of instances like this. The line that we draw is that you have to have citizenship or green card permanent residency before we can invest. The reason behind it is that you have to be able to form a Delaware C Corp, and more importantly, I know you can do that as a non-citizen or resident. You have to be able to employ yourself legally in that Delaware C Corp. So unfortunately, we're not able to support with this in-house. We do have a number of partners that we work with that we refer folks to, law firms, service providers. So we try to do all we can within the constraints that we have.
You guys are asking really, really good questions, so please keep it up. The other thing I will do is when someone asks a question, I'll probably repeat it just so that our folks online can actually hear what the questions are. So they're not trying to guess.
So I guess you will could you mention really comments and what strategic campaigns?
Yeah, so I'll give you a couple of examples, some of them global and some of the US. So one of the most successful companies, the first unicorn out of Antler is a company called invaluable. If anyone's used this, it's essentially an eSIM marketplace where if you land in whatever, London, you've used it before, or Amsterdam, or whatever it might be, you can plug into a local carrier via the eSIM. So those were two guys who met in our Singapore program. I think it was the first or second one. They didn't know each other prior to this company. This company couldn't really conceivably exist without Antler as a platform. One of them had a product engineering background, one of them had a telco background, so we understood the problem statement to a significant degree. They formed a company and they've been off to the races ever since. It's also an interesting example of the global competitive edge that we can start to create by having this decentralized network of different funds across the world. So this is an example of a company that obviously originated out of Southeast Asia, but when they got to a Series A, we moved to the US, and we were able to support them through the infrastructure that we have here. So one thing that we can offer that's somewhat unique given the hand-to-hand combat that we went through over the past few years to launch all these locations is have a company that wants to expand to Central Europe or India or whatever it is. I can plug them into my peers, their network of investors, their network of early hires, basic things like office space, potentially visas, or support them. So Arella is a good one to take a look at. It's also consumer and probably relevant for everyone in the audience. I focus more on B2B investing, which isn't a firm thesis, but just a personal bias. One of my favorite companies is a company called PowerX at the US portfolio. To give you a sense of how early stage we invest. So the founder, whose name is Manu, came to our first New York program. He was formerly at World Bank. He was an energy consultant at McKinsey. And he came into our program with as vague a problem statement as he wanted to solve the issue of climate change. What he was able to get is reducing emissions. And that's really where the he spent his entire program trying to build out a hydrogen scooter, which wasn't feasible. You have to have a charging apparatus that doesn't work. But went through a series of iterations and eventually landed on PowerX, which is an IoT device you plug into water heaters. The value is really on the software side, the hardware component to the earlier question. You plug into water heaters and they'll essentially monitor and then eventually optimize what the energy output should be. So it's applicable for residential as well as commercial. Where he's really found traction is hotels, commercial buildings, quick serve restaurants is a huge one. But it gives you a sense of like, this was nothing when he came in. It was just a high quality individual who's incredibly inspiring, who had a problem statement that made sense for VC. And then that's kind of the journey we went through initially, and then companies now a series of stage. Yeah,
Good question.
Perfect. Yeah, so it's around what mechanism we use to invest. So for our pre-seed and seed level investments, it's always done on a safe. It's really
the safest.
yeah. So a simple agreement for future equity. YC came up with this. They did really
Y Combinator
came up with this. They pioneered the vehicle. So it's basically a 2-page document where you are essentially securing the promise to receive shares in the future. Should the company go on to raise a price round, which is an investor actually coming in and putting a price and more importantly, a price per share on the company. So the simplest way to invest is an early stage. VC or angel has become more and more common. It's the most common thing that I use now for investment in those angel portfolio companies. Yeah, we use the stage. It's simple, it's founder friendly. The precedent is there at the core, so there's really nothing to worry about. Pricing all of these rounds to the volume that we do as an investor doesn't make sense, and it's a legal and expense burden on the founders.
So the reason we love stage agreements, because one of the most difficult thing at the earliest stages of a company, before you have revenue, before you have customers, before you have established that, is to determine what your company is worth. You could debate it all day long, and at best, it's still a guess. This allows you to kind of punt that conversation a little further. It's an acknowledgement between two parties that says there will be value there. We suspect there will be value there. We don't know what that is. Let's kind of enter into a partnership now, and at the point where real value is established and an investor gets priced, then that makes sense to actually convert at. So these agreements are becoming far more popular, but it's also accelerating not only the number, but the ability to do these deals and get capital into the innovation system.
Yeah, no, I think that's the deeper point, is that coming up with a price for companies at the stage that we're investing in, but even if you get to that 3C plus and C, is nearly impossible to do. Then it just becomes this kind of substances, kind of no substance conversation with founders. So you're essentially getting future equity that's purely on paper. You don't actually get anything. That's
Well, since that's such a good question, what are some of the kind of terms or things that might be in a safe agreement that people want? Because you talked about the cap and all that.
Yeah. I think that cap versus discount or a combination of both is probably the ones that we invest on a post-money cap, which is our investment plus the price that we're agreeing. What that allows us to achieve is, if I invest in this company at a $3 million post-money cap, and then they have a price round of $10 million, I'm converting it to 3, so I'm getting my ownership at that point. Other folks decide to invest on a discount, which is after you invest at a 20% discount of what the next round is going to be, which is exactly what it sounds like. You're going to get 20% of what the price is going to be at the point of someone actually coming in and converting it. Other things to watch out for. I mean, the way that I would really, I think, simplistically define what to watch out for in term sheets is price, which we kind of just referenced, but also governance. I'd be super gun shy at the early stage to take on an investor who wants meaningful governance in the company. Maybe they want a board seat. That's probably the best thing to think about. We don't take a board seat. We don't even take an observer seat. So we get information rights, which is an aspect of governance that you have the ability or the right to get board level documents, access to financials for your audits and things like that. But as a caution to the audience, watching out for governance and optimizing the price is probably the easiest thing to.
Oh, look at all the questions. This is wonderful. I'll let you kind of, who shows you.
Yeah, we don't really worry about it because it's so early stage. We don't have any claim on the IP, so I suppose that's most relevant in the event that we don't invest. So just to be super clear about this whole thing, we accept these 50% of the founders into the room. We'll invest in roughly 20% at the end of the process. But folks have the option as to whether they want to invest or not. If they decide not to invest, there's no claim on the IP. That's part of the question. The IP is owned by the company. So the point of our investment decision, the company then goes and gets incorporated. We help with that process. The IP is attached to that corporate. We're a shareholder eventually in that corporate. Does that make sense? Great job.
So I looked up that Antler was founded in 2017, so it's kind of a startup.
100%.
How did Antler pick up the lack of experience that other more social be able to offer?
Antler 100% is a startup in and of itself. So we founded the company in 2017, launched the first fund in Q3 2018. So we're not coming to the table with a significant track record. We are a high volume investor. We have about 1,100 portfolio companies globally. We expanded. We're on a run rate to do about 500 per year. But our competitive advantage isn't tied to the amount of unicorn outcomes we've had so far, because we're just too immature to be able to achieve that. What we really raise funds through is the kind of premise of what we're building, right? Entrepreneurship needs to be more democratized. We're solving a problem at the earliest stage. Portfolio construction question that was asked earlier, and then indications of track record. So full candor, I'm in the process of raising our second fund right now. We raised, like I said, 35 million for our first fund. We're raising 150 for our second fund. We're over halfway there. So I've been spending the last 9 months of my life on a plane trying to go and convince investors to take a bet on us for our second fund. What tends to resonate is track record so far, which is still meaningful, right? We have 4 years of maturity into these companies. So our companies in the US are kind of going to Series A right now. So it's some indication that this model is working. Application level data is worth noticing. So our applications are up 84% year on year, which is pretty meaningful. That's the most important leading indicator for me to show that we're onto something. If you can get the best founders in the room, your allocation into them will ultimately be successful based on this portfolio construction is my thinking. And then just competitive advantage. How do you compete across the world, and how do you enact this kind of global infrastructure that companies down the line? So yeah, no, I think that you can't compete on track record until you have we have a semblance of one, and it's getting better and better. Our Southeast Asia fund, again, is the oldest fund, so they're about 2 years older than ours. They're in the top percent for Southeast Asia for their performance. So that's helpful.
What is a unicorn?
Oh, sorry. Unicorn is a company that is valued over $1 billion. They started calling it a unicorn because it was incredibly rare. It's not so rare anymore. So there's new terminology probably on the way or already emerging.
They do. They've got new companies, new terms. Exactly. That is what it is.
So what would you say is the biggest differentiator for an early stage company maybe succeeded at what stage you think is a very big company? So first is product is solving a big enough problem, like you said about coming out with the first version. Then the second one I can think of is the product is available. I have something to show you. Third is we have some revenue plan, like the plan. Fourth is we have some customers who are not paying. And fifth is we have some paying customers. So like rank it.
How would I rank it? I wouldn't. So all I care about when I'm evaluating an early stage founder is really two things. I think this is all that matters to go from 0 to 1 as an early stage founder. Can you build technology and can you sell technology? And then the assumptions are, is there actually a market there, both in terms of whether you validated that there's a there, there's a customer base that's willing to actually connect with this future solution, and then obviously is it sufficient for venture capital? So a lot of businesses, this is true for folks who go through the Antler program, will discover that the solution that they're building is better suited as a small business, a lifestyle business for themselves. That's brilliant. We encourage that, but we're not able to invest in it. So 10 would be a total addressable market example. Some of you would look for there. But again, to boil it down to its essence, what we're investing in is incredibly high quality founders who have demonstrable evidence over the course of 8 years that they can validate a problem statement and then build tech and sell tech. And that's as simple as it gets. What I'm not underwriting is the business model. To your point, the assumption that I come in with as a pre-seed investor is the business model, and to some extent the market, is going to change radically from my pre-seed investment to what this thing looks like at seed to certainly what it looks like at Series A. That's a good thing, right? So I can't underwrite the business model. I can underwrite the critical thinking around the business model to a certain extent, but that's really just not the founder, which is the whole point. So again, all I can focus on is can you build tech, can you sell tech? Is there something there? The only other intangibles that are perhaps worth mentioning is this someone who has the gravitas to hire incredibly high quality folks? So is this someone who can hire a 10x better engineer themselves? I think that maps onto fundraising as well, which is the reality of building a company. Is this someone that I can put into a best investor in my network where they can sell themselves? Being a good storyteller, which Greg also talks about, is incredibly important.
You mentioned you kind of have how do you see?
We don't. We just we offer standard terms. So yeah, again, to Greg's point, you really can't get evaluation at the pre-seed. Just all your imagination. What you can do is create a deal for the market that is both friendly enough to where you're not taking predatory economics, and secondly, make sure that your portfolio construction works. And drive. The pre-money versus post-money thing is perhaps worth commenting. Pre-money is simply the valuation prior to your capital. Right? Post-money is the valuation coming in. So in our case, it's
there's a lot of entrepreneurs, a lot of whom I've read about especially, who were unwilling to take on VCs, media advisory shares, or even like shares that would give them the power to make decisions. So how do you deal with entrepreneurs? Do you generally try to be more on the advising part of it? Do you help them, or do you generally ask for the ability to take decisions and actually have votes in the board meetings?
Yeah, we take no governance again. So I think what's important to understand about this question, this is around how much control an investor may have or influence an investor may have. A given company, we don't take board seats like I mentioned earlier. We don't have a sufficient amount of ownership, particularly as we get diluted alongside the factor over time, for us to have meaningful influence. The influence that we have is really predicated on trust. We're in some ways the de facto third or fourth co-founders of a lot of these companies because we're in the whatever whiteboarding session where we come up with the idea. So we build a lot of trust that allows us to have influence, but that's only determined by the founders' willingness to give it to us. We don't take anything as a pre-seed investor in terms of actual formal governance legal sense. You will expect to start to give away some of that for good reasons over time. So, I mean, most of my companies, when they start to raise, I would say a meaningful seed round would be $2 to $3 million. Usually you're giving away one board seat. It's not to say that you should never give away the governance, but I wouldn't advise giving away any kind of control or equal presence to someone who's coming into a minority shareholder, particularly given that's going to become more and more minority shareholder as you get myself included. I wouldn't ever give board seats to agents, for example. I'd be very cautious to your question on giving away too much advisory shares. I've seen so many companies over the past 6 or 7 years give away the advisors who promise a hell of a lot of them actually. Insofar as you want to bring advisors onto your company, I think that there is sometimes merit to that. I would have it tied to one, a timeline, so investment schedule, so they're earning equity over time and to continue their involvement, or package milestones where someone's coming on board to help with product development. You map out the product roadmap and say, these are the deliverables in which you're going to start to invest your shares. In my view, that's a more productive way to go about it, but on the product side, it's a little bit more complicated. On the sales side, it's more straightforward. Right? You're going to get more shares once the company hits the $1 million mark.
How do you fare with VCs as you proceed with your company?
What was the first part?
How do you fare with other VCs investing in your company as you proceed through the stages?
How do we fare with them in terms of how do we interact with them?
Yes.
Yeah. So we tend to play nice with every other investor because we're really creating deal flow from scratch. So it's an earlier point, these are companies that otherwise wouldn't exist if it wasn't for Antler as a platform. A lot of times are being the co-founders during the program. So we're solving a meaningful problem for downstream VCs where they're desperate to see more and more deal flow, particularly quality deal flow. So we tend to have this mutually supportive relationship where on one hand I can pass along new deal flow to the market and that's and it gets received well. On the other side, a lot of VCs see high quality founders all day long, but they're not quite at their KPI threshold to invest as their fund, right? So as opposed to us doing 225 investment spreads, they only do 30. So they're much more selective and take bets. As a result, they might invest at a later stage. We can solve a problem for them where we're a great landing pad for that high quality founder in their network to come to, as opposed to a pure rejection. Again, the one being that we can send deal flow to the market. We do this in a fairly programmatic way because of the volume that we're investing in. So I referenced the second phase of our program culminating in the investor release. How it specifically works is it's a 4-week long sprint where we will be taking our investments to our LPs, our limited partners who invest in the fund. They get proprietary access to it. Week 2 would be our inner circle of VCs. So folks that we know play at the pre-seed plus seed stage, and we know that they're receptive to our deal flow. They get early access to it in week 2. Week 3 would be the wider distribution of 2,000 VCs that I know, US and globally, and each partner would do this on kind of an individual basis. So in terms of your interaction with the company, I'm going to the partner that I know in Sequoia with 3 deals that I know in their strike zone and in their kind of sector deals. Week 4 would be a public release, where you're essentially analogous to the Y Combinator demo day, if everyone's familiar. You're essentially taking the companies out of stealth. So that's kind of that's the way that we interact up until the seed stage. It becomes more curated when you get into Series A and beyond territory, where it's more one-for-one introductions, and the cycles are less predictable in terms of how many going to raise.
Usually when you syndicate deals, you look for partners who bring complementary value. If you have a strength here, they bring a strength that perhaps you don't, or the compound of the strength you have. Introduction to markets, introduction to talent, deep domain expertise and knowledge. There's just all these things that come in because the check you write into a company is probably the least important thing you contribute to the company. Once you write that check, we call it influencing without authority. Really the influence you have in the company is what you bring to complement what this hard team of workers is actually doing.
And one thing I would index for, given that we're a generalist investor, a lot of times what I tend to support my companies in doing is bring someone onto the cap table who is a deep domain expert in the given industry. So for the power example that I gave earlier, or the Relo example, having a generalist investor is great for the early stage support that we give, and obviously the capital is something. But how do we then bring on, in the Relo's case, deep domain expert in telco? How do we bring on someone who has the kind of credibility as well as introductions and ability to really do it? That's something that, for what it's worth, personal opinion, I would optimize for. Yeah, so the question is around investor relations. Just to clarify, investor relations from like a fund perspective, so how we interact with LPs, we do. So I mentioned Antler is kind of a decentralized model earlier. How it works specifically, there's a management company at the top that we raise equity into, and then essentially support the expansion of all these underground funds. So there's 15 pre-seed funds across the globe that are carved out by region. The U.S. is the one that I'm responsible for. There's a capital team at the management company level that is useful in helping raise money for the underlying funds. So you've met Charlie. So Charlie is our head of capital for the U.S. He works alongside me to help go and raise money as well as interact with our investors after that. So one of the things that's been actually quite key to our success is building out this capital function so that folks like myself, to the best of our ability, can focus on supporting companies, helping them raise capital as opposed to having conversations with LPs. Having conversations with LPs has been a huge part of my life recently, but it would be a hell of a lot more difficult if I didn't have a capital function behind it.
So I feel like tech VCs have gotten a bad rap in recent years. Actually, the companies that have emerged from them that turned out to be scams, right? So do you have any watching tips that help you separate the new Steve Jobs, Elizabeth Holmes, or
yeah, so the question is, the question's around how do you avoid charlatans is probably the nice way to put it. I think that our advantage, I mean, I don't know, like from a industry level standpoint, I don't know. You have to actually evaluate the technology in most of those cases, right? So someone obviously missed the boat in terms of actually understanding whether the tech worked or not. And they got bought into the hype cycle in the case of the latter case of crypto. That's something that we avoid, which in hindsight could have worked out rather the other way. But don't be tempted into the hype cycle is probably advice that's worth following to generalizable. And then my advantage is I actually have a chance to work with folks over the course of this period of time. And it's like a short period, it's actually quite long in time in the Antler program. So it's hard to hide when you're interacting with someone day in, day out in various formats. So the coffee chat that I'm having with them, in the whiteboarding session, the speaker session, it's difficult to continually lie about what you're actually building. What we're underwriting is the traction that we see in the company. So like I'm taking a scorecard, for instance, on did this person deliver what they said they were going to deliver last week, and am I actually able to observe kind of taking their word for it. So not taking their word for it is probably the best advice for how I intend to avoid it. And then the other thing, just from a risk management standpoint, don't make overweight bets in things that you don't know well. So the earlier question, like why am I not investing in therapeutics? Because I don't know anything about it. And I can easily be tempted in the scam direction.
I'll also say one, in general, you avoid the herd mentality if you can. You kind of get buy into the, so one of the big drivers for deals like those were fear of missing out. oh my God, if I don't invest, look at everything I'm losing by doing that. The other thing is that one of the signals we saw in a company like Theranos was the fact that almost all the board members and all the advisors had absolutely nothing to do with the industry that they were going into. That's a huge red flag for us. If you were really that good in solving the problem, you should have every major expert in your particular field wanting to kind of support and do what you're doing. So sometimes you can pick up on some kind of smaller red flags. In terms of the Samuel Bankman Fried, that was again this kind of gold rush mentality that, oh my God, I'm going to lose out by not being part of it. And you also have to be careful because one of the things that Ryan and I were talking to earlier, one of the superpowers of great entrepreneurs is storytelling. The ability to transport us to some point in the future that is not only exciting, but we see ourselves playing in that future. And sometimes, it can give us kind of this false illusion of kind of where we're going. So you learn that, but I think we've all been guilty of not always reading the signals well.
Definitely.
Yeah, so could you clarify a little bit more? Companies for the platform, 3% of those applications after the 8-week period, 10%. Yeah, the 9%, 3 months after that.
That's exactly right. Yeah. So the only thing I would add is we run 2 programs per year. So one is in the spring, one is in the fall. Our next program round is coming up April 2nd. That'll be for Boulder, Austin, and New York. Those are kind of carved up by regions, which is a separate point that's worth noticing really quickly. So Boulder is focused on the Mountain West. So it's not like founders in Colorado. 70% of my last batch came from outside the state of Colorado. So it's focused in Salt Lake City or Bozeman or New Mexico. We have a lot of people in the West Coast. Proximity. Austin, servicing the Southeast, New York is a global city, the Northeast. Yeah, exactly right. So in terms of the timeline, just to clarify for everyone, we're an application process usually between, in this case, Jan to end of March. Program starts in April. Program is 8 weeks long. So there's, again, no downside to joining Antler. It should only be a positive experience, plus you receive investment, or ideally just a positive experience. We also, in terms of the deal, it was assigned if they're relocated to one of our cities. No cost to participate in addition to potentially assignment. So if you're coming to San Diego to Boulder, for instance, you get, I think it's $2,500 for the period. That's just costs, opportunity costs, housing. And then over the course of 8 weeks, we'll focus on all the things we spoke about, make an investment decision. The median is 20%. It's not a quota-driven system. It depends on how available in a given cohort. To give you one of contact, the last program I had 11 companies pitch at our investment committee at the end. I invested in 9 of them. So many folks will go through this experience at the earlier point and discover, hey, I don't want to do this for the next 10 years, or I haven't quite cracked it and I'm not ready yet, or this is better suited as an asset for your lifestyle business. So the percentages are starting to understand pensions versus receiving investment. 250K is what you get at the end of the 8 weeks. You're issued 2 term sheets simultaneously. So the first one is the 250K for 9%. That's prior to immediately sort of thing. And you get a second term sheet you take to market for an additional follow-up. So another 250 that you can use to go to the other set of VCs you want to work with alongside us and say, hey, my initial investor is already committed to a specific capital amount for the next round. We're not setting the terms on that. Again, just to be clear, that's uncapped. Right? So whatever terms the next investor comes in at is what we're going to come in at for the so our blended valuation starts to go up as a result. So I'm investing in a $3 million valuation, they raise 10, whatever it is. And then our continuity fund becomes an important thing to understand post-seed. So 3.5 months to get to seed, ideally you raise at that point. We're still quite actively involved with those companies at that time. And then we become more passive as a pre-seed seed investor when we start to gap to seed. We have this continuity fund that's much more actively involved in that. They will only ever go up to a co-lead position in the rounds that they're investing in. So one thing that's important to understand is probably an industry level point that is worth mentioning is we're never marking up our own home, right? So other names that other funds have fallen into this trap continually mark up their own positions by competing next round after the next round. Artificially inflated portfolio as a result of the racking of the a lot of those funds will only ever follow on or go up to a co-lead position, but never set the terms of the rent for the subsequent investments. So we're there as basically the financing arm resource arm for our currently that scales to Series C. The intention is to then raise a fund that does pre-IPO. So we can, again, literally lead that to the journey from zero all the way through the
You just mentioned 10-year marriage. Every investor is probably 10-year marriage, right? But I'm sure you know that, to get into that journey with someone or founders, trust is very important. Is there like a phase where before you invested, you work with them at some level to understand who you're dealing with? Because I'm sure you know that there's a lot of founders who are either smart or capable. You wouldn't trust, right? You wouldn't put your money. And so what are some things you do with them before they do that? That tells you kind of who you're getting.
That's the whole value of the first phase. So the first stage. So you're working alongside them and building the company for 8 weeks prior to making the decision. So
that's still a lot of people that you're working with every week.
Yeah,
you
so
really get to know everyone.
To the best of your ability, but I mean, as opposed to what most funds do, which is that you're running a series of calls prior to making a call in the company, especially the pre-seed level. Yeah, you can, right? So in a few different ways. One is your personal opinion on what the interaction has been like. There's also an interesting social kind of experiment aspect to what Antler is, where the cohort tends to weed itself out. So the top 20% tend to rise to the top quickly. You get a lot of quite interesting data points from the founders about one another, which is interesting. This is something that's fairly in the program. So it's not to say that we can do it with a 100% level of confidence, right? The reality of a venture is, I think, for understanding broadly, is 70% of a given portfolio is going to die, right? So 70% of it is going to be a write-off. 30% is going to survive. 10% is going to fall. I think that a lot of founders don't necessarily understand or appreciate that math, and why you have to have such stellar outcomes to actually return money in this business. But yeah, to the trust question, you usually can do what's available. I think that we have an edge.
Just because you invest in
and working in person is also noticing here. So I think you pick up a lot more by working with someone in person, relevant for the day and age that we live in now. I think that's even more applicable to the co-founder relationship, which is really the same premise. How do you develop a co-founder relationship over the course of the weeks? In my view, it's a hell of a lot more effective to do that in person because it's the offhand coffee chat that becomes a whiteboarding session. Becomes something that's actually for the company. I ran this digital by necessity during COVID. There's a lot of it. And the intangible.
So as far as the success rate, you said 10% to the fund. That's 10%.
That's just typical venture math. So it depends on, that's not applicable only to us. That's really how the industry views it. So it depends on your tax size, your ownership, what stage you're coming in.
So with 250 founders, you expect 5.
Yeah, we'll do 125 investments at the pre-seed in our next fund as an example. So roughly, I mean, it depends on the motivation and there could be huge stratification there, but roughly 10% is what's going to return.
What are the things that the top 10% look like? What are the negatives that drop down?
It's a good question. So the question here is, what is the percentage of folks that are successful during the program, and what are the ones that are successful? Again, I mean, just to be super clear, it's not always that they did something wrong in terms of why they didn't receive the investment. Many folks walked out of it. It's actually critical to understand that. What I see folks do well is, hyper focus on building and selling technology. So again, the only two things that matter. It's a generalization, but it's quite true in my experience. So the folks who often spend their time ineffectively during the cohort are the ones who are, continuously focused on building the best presentation, building the best financial projection, right? A bunch of stuff that doesn't matter unless you actually have a problem statement that's validated, discovered, validated, and then a solution that's actually feasible. So I think focus is probably the number one thing to notice here. Is it a founder who actually went heads down, interacted with customers, started to build a solution based on that feedback, and then was able to demonstrate that to us versus continually focusing on the best story possible without any substance. You can raise successfully on that, and we spoke about some examples we did earlier, but it's not our focus. I don't think it's a sustainable strategy.
Yeah, so I guess one thing that I've always heard from other sources is like look at competency and like entitled solution. But I guess like me as a college student who hasn't done much in industry or other places, we might not be some I guess be involved. So for example, the person in New York was working on right in water meters. Something I would want to do, for example, and it's like would you recommend limiting problems where someone is expertise, or does it make sense if I have software experience from other industries like, hey, what is your take on that?
I wouldn't lead with what your skill set is versus what your expertise is focused on. For what it's worth, the average age of a founder that we invest into is 32. So it's a fringe minority of folks that we invest in who don't have some kind of career. And the reason for that is exactly what you're trying to highlight here, which is do they have the sufficient amount of the expertise? Have they discovered a problem where they actually have some depth of understanding and credibility around solving? It doesn't change my advice though. I mean, I think that it doesn't necessarily have to be a problem that you personally relate to always, but it's a problem that you have a commitment to understand better than anyone else in the world. The reality of building a business is that you're constantly competing, and there's people outside your door who do more than you do. So what I would underwrite is, do they have a depth of understanding, and if it's insufficient, do they have some evidence that they're committed to solving this problem and learning everything they possibly can over time. But yeah, for what it's worth, I mean, we had one investment, actually our first active in our US portfolio. 2 college students built a company called FanFix. You guys have come across it. It's essentially a clean OnlyFans is probably the best way to describe it. But they did incredibly well. They required early on, within 8 months of us investing, the company got bought. And those guys, I think one was a junior university and one had just graduated. But they had discovered the problem because they had a network of folks in LA who were in an influencer space and recognized that there was an opportunity to build a clean version of OnlyFans. This is when OnlyFans was just getting started. So there's certainly examples of problems that might be applicable just to your generation, or that you discover kind of your own. But yeah,
no, I mean, when you walk through the world, most people walk through the world and just see problems and complain about all the problems. Entrepreneurs say, hey, there's an opportunity, there's an opportunity, there's an opportunity. And once you do it, you find an opportunity, it's an observation, you then say, I think I can solve that problem, or I think that there's a way around it. You come up with a hypothesis, you model it, you're doing it. It's literally just these kind of small little micro steps of kind of doing this stuff. You just see an opportunity and say, I think I can solve it, which is why entrepreneurship is very often stimulated through role models. You see someone else doing something, you're going, I'm smarter than them, I can do that. Or I have a view on this, and I think my idea can be good. And that's why we create programs like this. So you have these safe spaces and places to test your ideas. And not only do it by yourself, but meet other people who share some of the same passion and ideas that you do. And we create the conditions. Because one of the things we say in our class is you absolutely cannot make innovation happen. What you can do is increase the chances that it will happen. It's not one of probability, it's one of possibility, which is why so many people love it. And what our job is to make sure that the conditions are right. Same thing with Ryan and with Antler. They create this 8-week program. What they're really doing is they're trying to give you all the conditions that give every possibility. So if your idea is viable and feasible and desirable, it has a pathway to see the light in this.
I understand you've spoken about trust, and one of the tenets of like an entrepreneur and investment relationships also, to some extent, we spoke about you don't actually have an advisory seat, but you still sometimes need advice, and I understand that you don't invest in young entrepreneurs. But you also said you have a lot of companies that you've invested in. How do you, at the same time, cultivate meaningful relationships with so many companies if you're significantly working for individual ones?
Yeah, I mean, good question. Yeah, it's a great question, and it's worth being super clear that just because we're not taking governance over them, it doesn't mean we don't have the capacity or the willingness to advise. That's actually what this whole thing is based on. Just for clarification, the way that we're able to accomplish this at scale is due to program sequence, right? So we're only ever focusing on 75 founders at a time during the first phase. And that's not myself personally, that's me alongside a team of 18 other people right across the US. But 75 gets refined down to 50, let's say, as people start to develop teams. You go from the individual level from week 1 to 3, let's say, to then a co-founder team from week 3 to 8. So that is in your favor in terms of just managing the problem of all this. And then you're only investing into the 20% that they at the end of the 8 weeks. Then you're dealing with maybe 9, 10 companies over the course of the next 3 months. That's a fairly manageable scale to actually work with in depth. And you're doing that both one-on-one as well as still in a group. So a good example to give is we host these town halls once a week, both during the first phase and second phase. That's an opportunity for the founders to get up in front of one another and talk about this is what went well over the last week, what went badly, lessons I learned, help that I need from the community. So you're able to do these scalably both group settings as well as working more in depth one-on-one. And then once they graduate from that second phase, you're dealing with companies you're going from C to Series A that usually have another investor on board who's helping alongside you. So that probably gets more and more manageable as you go. So you have to sequence it this way. You have to do it programmatically in order to actually. But also, if anyone's interested in getting into this game, it's pretty full on all the time. You don't feel the calls at 11 p.m. for someone who's a crisis. So if you want to work in 0 to 1 for anyone in the audience, make sure that it's really for you, because you have to love this stage in order to be successful. You have to really keep the social appetite to be able to do so. But it's a lot of fun if you have it.
So what he's referring to, kind of this 0 to 1 stuff. There was Peter Thiel talked about this concept of how do you go from 0 to 1. Starting a company is very different than scaling a company, and that 0 to 1, that kind of starting it, is just a very skill set that feels and behaves very, very different. So when you hear him kind of talk about that stuff, that's what he's really referencing. And as he said, taking calls at 11 p.m. Because when everything's going right, everything feels right. But the real test of an investor-entrepreneur relationship is when things aren't going well. Does everyone kind of roll up their sleeves and say, okay, let's solve this together. Let's kind of figure this thing out. Let's figure out the best way forward.
And then be a therapist to a certain extent. That's not a joke.
You really, really are.
Okay. Just behind you.
What do you guys look for? You like the 80 model. What are you looking for? Like, talk about like the company side, or like those 80
personal. The staff that we have. Yeah. So it depends on what level you're coming in at. Like I said earlier, every partner at Antler comes from an operator's background. So these are folks who have, like myself, worked in early stage companies for a decade minimum. They've built and scaled and ideally exited companies in the past prior to coming in. That's critically important because, again, to this trust point, founders want to work with people who have actually been in this, particularly at that 0 to 1 stage. So what we like to avoid, for what it's worth, is someone coming from an investment banking background or coming from a management consulting background. That's all they've done. Not to say that can be a part of the resume. If you purely worked as a corporate strategist or worked in private equity, is probably a better example where your tendency as an investor is to run the most sophisticated financial projections model that you possibly can. You're probably not best suited as a 0 to 1 investor, which is really that undervalued people. So that's what we look for at a partner level. It probably maps on to the next tranche, which is at the principal level. Those are the folks on my team that are focused on sourcing great founders, starting to do the initial diligence, and then working their way up to becoming an investor over time. And then kind of the associate level are usually folks that are 1 to 3 years in the workforce. So that's a slightly different example. Ideally, if you have relevant startup experience, there's going to be more rare and less substance. So it's more about kind of commitment to a lot of VC over time as the deeper one is optimizing the interaction of careers because they can build those relationships.
Sounds to me that you've had a lot of experience sitting on both sides of the table in terms of pitching and being pitched to. Do you have any experience advice for people who are pitching? Like, do you have any advice for being in the hot seat yourself?
in terms of raising capital. The first thing, which isn't decided to do that on secondary, is decide whether you want to raise capital. So for a lot of folks in this audience who are starting to build their business, they might be romanticizing the notion that venture capital is what they should raise for the company. So the first decision point, and I'll get you a question, is do I really want to bring on VC level money and all of the requirements that come along with that? So raising from venture capitalists to the portfolio construction earlier, the expectations is that something that's absolutely massive. Not every business should do that. It's actually a fringe minority of businesses that actually do raise. Any tips on kind of pitching? I think that it's stylistic depending on the person. I've heard, pitches from tactical people that, spoke only about the product, and heard pitches from people that are more focused on the market that were incredibly charismatic. What I tend to optimize for is someone who can run an investment pitch without a gap. So someone who is focused purely on problem statement and product. So the best investment pitches that I've ever seen is someone who just had a product demo and then answered questions afterwards. So it's hard to generalize what the tips and recommendations would be. It really depends on what you're building, what your personal style is. So I think authenticity is probably a good one to call out. Be sure it's authentic to what your style is.
The other thing I would say is be memorable. Because emotionally, the three things you want to do is get people to remember you, get people to care about you, but most important, get people to act, to do something with you. Set the next meeting, have a conversation and do that. And so one of the ways is just to be memorable. Did you still have a question back there?
So are we avoiding?
Yeah.
Yeah, so the question here is, what do we do week to week during the first 8 weeks long? Again, I try not to over-engineer it. So the point that's worth noticing here is that it's really unstructured intentionally. So you're creating the best community possible, and then again, the white space for them to go and create. There are some differences week to week. So I would say that weeks 1 through 2 are more focused on the social programming, because finding co-founders is a pretty significant emphasis of what folks are looking for when they come in early on. Weeks 3 through 5, I would say, are more focused on problem statement discovery and validation. So going out and speaking to customers, and also battle testing your co-founder relationship probably is the one there. And then 5 through 6 is really refinement. So it's starting to build out some semblance of a solution, and I'm talking about prototyping and product stuff. And then you get to inflection point where we have a pre-investment. So week 6, we make a decision as to whether you are going to advance as a team to the week 8 formal investment. So there's an inflection point there that's worth understanding. But assuming that you progress, week 7 becomes more of kind of an investment preparation week. So there is something to be said for making sure that you are polished. You're still building your company, so like 10% of your time is focused perhaps at that point. You have additional clarity on building out the materials, but you're still doing what matters, which is building it. And then week 8 is the real thing. In terms of, again, characteristics, what we're underwriting over the course of 8 weeks is the momentum that someone has, right? Who has the team have over the course of the program. So is this someone who came in week 1 and achieved kind of a straight to the right trajectory in terms of building product, selling product over the course of that period of time? And then again, I mentioned earlier the certain intangibles, right? You have the charisma to bring on really high quality early executive funders, or you can start with things like that do matter. Are you a first principles thinker? You can test that by evaluating various things both in the program as well as in the
So how do you predict about users you like to do?
Yeah, it's a good question. So it's around how do you stay current as well as like the generalist investor. I think that you construct our partnership where every individual partner has a unique set of kind of experience and interests that we would like to invest into. So I do a lot of fintech investing, SaaS investing, different investing, particularly relevant for whereas my partner in New York might kind of be more focused on partnering also focused on, space defense or whatever. We try to construct a partnership where we have relevant expertise across all of us. We have 18 people in the team, so you're able to pull pretty diverse knowledge there. And we have folks who we work with closely on the advisory. We have 850 folks who are various expertise, across various industries, whether they're existing executives, whether they're exited startup founders, whether they're currently working in a startup. So you can pull from this bank of knowledge, both as a founder in terms of access to them, but also myself as an investor. So you can do a lot of data on is this technology actually feasible based on your experience. So it's really more driven by work than anything else. You probably have better recommendations in terms of blog posts and knowledge.
Yeah, so it depends. So for the kind of domain and sector knowledge, for the finance side, every day I get Dan Primack's newsletter into my inbox. He's been in the VC world for a long time. Every company that's getting funded, every trend that's happening, you kind of read it very quickly within probably a minute, 2 minutes. You kind of digest what's happening that day. In the sector areas, newsletters like TLDR are great because you can choose certain sectors, whether it's what's happening with founders, what's happening with AI, different ones. So you can kind of consume that in little bite size. But choose the people that you enjoy following. Who are the people you look up to? Who are kind of the people? And chances are they have some kind of a blog or something that they're doing where you can consume tech, consume the knowledge.
Infinite podcast, obviously has a good one. 20-minute VC is decent. All in is best. Your style is pretty good. I would optimize for is a good one. I would optimize for a podcast where it's actually founders talking about building their companies, particularly 0 to 1, if that's what you're interested in pursuing. Capital Allocators is a good one on kind of the investor and the investor related question earlier. And that's quite cool. Good.
Go ahead and apply to me evaluate.
Yeah, super straightforward. So Antler.co, you essentially go on the website, you choose the location that you're interested in applying to. And then the interview stages to get to this 3% are, you have initial kind of application screening. So you're putting in track record, things you've experienced in the past, as well as the problem you're looking to solve. That's then evaluated by our team. This is the most tedious thing. Working Antler, but it's also the most important thing we do. Then you get to a first round interview, which is usually done with a principal on our team, and a second interview done with myself or one of the location. Then the decision is made.
Just curious, how do you choose what city you spread to? Why Boulder?
Good question.
Yeah, it's an incredibly important question. I mean, in that example, in hindsight, we could have probably easily chosen Salt Lake. There's a number of factors. Some of them are selfish, some of them are motivated by the ecosystem. So we landed in New York for fairly obvious reasons. Right? It's a global center of capital. It has a sufficient population size. It has enough tech density. It's ranked 2 in terms of number of ventures created. Then again, the intention was to come to California. We were debating which location in California to come to. Then COVID hit. So Austin obviously got a ton of publicity during COVID. Folks moving there. There's something to be said for that. So there's a lot of people that were moving from the Bay Area across California, the Northeast to Austin. So it had the necessary ingredients in terms of founder quality, which is the most important thing. Enough downstream capital, so enough investors who can invest after we make our initial investment. Enough limited partner kind of appetite, so institutions as well as your family offices, high net worth on the ground who would be attracted to our kind of Austin story. And the same thing was true for Boulder, but it also requires someone who's willing to raise their hand and be like, hey, I want to go and launch this location. Boulder was a place that I saw a lot of potential in. I want to live there personally. But you do need that. Like it's kind of a joke, but you need someone who's actually willing to go and take a plunge to show up and build this thing out of nothing. And yeah, I mean, Boulder also had the legacy of Techstars, so it's already known as kind of an attractive place for early stage entrepreneurs to come to. I think the decision could have easily been Salt Lake. I spent a ton of time in Salt Lake. Utah in general punches way above its weight in terms of creating full startups. But again, it doesn't really matter because it's more of a regional approach, right? So we're playing Salt Lake from Boulder, and we branded as the Mountain West in the same way that if we launched San Diego, we branded as Southern California. And it is true because we're spending time in those markets. I have a full-time hire based in Salt Lake. So we have this kind of and spoke model where the hubs would be the cities because of the programs in, but then the spokes would be, we have someone based down in New Mexico, someone based in Salt Lake. So it's already based in the works out of one day a week. But his responsibility is to bring high quality standing with founders to Boulder until we have a presence.
So, I guess I could mature versus are there any things with founder competitions harder as a startup base?
Yeah, there's a few different layers to that. So in terms of trends that we're seeing both in the sector as well as kind of teams of capital. Teams that are smaller now, I think that they're not as small as the headlines might want to give you, whether it's going to be the next $1 trillion company started by one person. I think that's entirely feasible. We're a ways away from that. We are seeing less of a focus on, building out a suite of 5 engineers for the idea stage level company because of the existence of AI. So that's a trend that we're seeing. I think it's very, very early days in terms of that. With respect to trends overall, I mean, I'm shying away from Gen AI for the sake of it. The last 18 months have been interesting on that topic in the same way that the 18 months prior were interesting with Web3 and crypto. I tend to avoid those hype cycles for better or worse. But AI is very real. What I'm interested in is what I kind of referenced earlier, where are we building LLMs and Gen AI for helping with drug discovery, for instance, or on the software side. So some of the real problems, I think that supply chain logistics are interesting within that, transportation, space, defense, life sciences, medical device. From a software standpoint, is where I spend my time and energy. Climate is a huge aspect as well. So I'm not writing trends for the sake of it, but I think the underlying technology is applied to real world problems is probably where I'm interested to speak as an investor. And then in terms of the kind of capital market side of it, so the last 2 years has been a bit of a bloodbath for founders trying to raise capital. That's particularly true, I think, Series B and beyond. If you guys saw kind of like the Instacart example, this is what we're looking at, where pull it up, it kind of shows the runs Instacart raised up until they eventually had their IPO, and no one beyond the Series B, I think it was, actually made any money because during the kind of 2018 to 2021 cycle, everyone's investing in valuations that made absolutely no sense for the mechanics of these businesses. So the reckoning came when interest rates started to go up. It's been very difficult for growth stage companies to actually raise capital. VCs have been prioritizing their portfolio for the sake of survival as a result of that. So early stage has been fairly insulated from that. So to give you one contact, we took 37 companies to market to raise capital last year. That was for pre-seed plus all the way through Series A. The bulk of it was at a seed stage. All 37 of those companies were able to successfully raise capital, which is the best batting average that I've had with Antler at a time when VC was down 74%. So I think that don't let the headlines mislead you in terms of VC being entirely down. I think that it's important to notice that kind of growth stage through beyond where so a fair amount of pessimism at that time. We're tight on time. Let's do it. You haven't gone yet. We're good.
Already in place. Here's those that is another and and my
I don't even draft myself. No, it's an interesting question. The first question is around what stage of maturity does someone come in at with they build? I think it really depends on how much time you're building. So again, what I'm underwriting is the momentum that you've made both prior to the program as well as after the fact. So if someone's been building for 4 months and they haven't developed something and it's a relatively straightforward technical lift to be able to do so, that's something that I'm going to have a bias against. I think that it's somewhat determined on what you're looking to build as well. So how evaluating feasibility with the technical build is going to be is a necessary requirement here. But yeah, I mean, what I'm trying to find out is whether you're actually going to be successful once you're at the wild with our investment. It's helpful to understand what you built prior to the investment to be able to do so. So I would say a general tendency would be I'm actually starting to build something prior to the program, but it depends. The other thing that I would consider in that scenario is, are they building prior to actually validating the problem statement, which is something that's quite core to my thinking. Is go and validate the problem statement, make sure that there's a there with respect to the market, and then build based on that feedback. Build quickly based on that feedback and continue to iterate as you go, but don't build prematurely and don't leave the solution. So somewhat nuanced.
What is right now? Those levels, understanding the processes of
In what respect?
What kind of projects would you work on when you're with going so much?
I don't know. It depends on what you're interested in, right? I mean, I'm not trying to dodge the question. I think I understand what you're getting at. There's no generalizable answer to it. I don't think. I think ensure that your motivations aren't that I want to build a company. Your motivations are, again, that I want to solve a problem that I care about, and a company is a valuable solution in order to do so. So I suppose I was just challenging the thinking in terms of how I would approach it.
There's also kind of a whole spectrum, everything from what we would call a lifestyle business, where you want to be a baker, a chocolate shop, or a auto repair shop. Those are perfectly wonderful ideas, all the way to the things that are kind of high potential, large market, high growth stuff. So it's really kind of what drives you for what you want to do.
And start small as well. I mean, the first business that I built was when I was a university student, and I built a coffee shop on campus, right? I learned a hell of a lot more from that experience than anything that any one of my professors ever taught me about actually running a business. So starting small is valuable, identifying a niche and not having everything. Everything doesn't need to be, potentially a uniform pathway, particularly at this stage where the real merit is learning.
In fact, I'd recommend that for you, because, the people who think that they're creating the next unicorn, or the majority of them aren't. We had some students at Berkeley who just had this epiphany that, between 11 p.m. and 6 a.m. it was really tough to get snacks, order food. So they created a food delivery service that delivered pizza and cookies and stuff to dorms, and they were insanely successful. But it was just like some little side hustle that they determined was really valuable. In fact, very often, probably for those people in this room, probably the first entrepreneurial idea you'll probably have will be a side hustle of some sort.
So what stage do you expect at the end of the AD period? So do they usually have a product and a business plan, or is it more ideas being shipped and added?
Yeah, it's an important question to understand. Again, I have to go back to the point that what I'm tracking is the momentum, not necessarily the delivery. The reason for that is that it totally depends on what you're building. So I think that you laughed out with an example of a product company before the session started. I had a founder come in who was at the problem statement stage, especially at the beginning of the program, at 100K in revenue over the course of the weeks. Obviously, phenomenal, clear investment that we should make. We track something to do with that. I had other examples like Power Action earlier, where we spent the whole time building a hydrogen scooter, which I wasn't going to invest in. I had nothing to do with what we landed on that 2 weeks prior to IC. What I was underwriting in that case was this guy is an absolute killer who can build stuff and to a certain extent sell stuff. So you have to curate it case by case because of the time of the program and because of the nature of what someone might be building. What you're again investing in is what the momentum is, and it's going to correspond. So
Gold sweatshirt, you have a question?
Good question. So around what niche advice? I mean, again, I don't know. I mean, what I would focus on again is discover a problem statement that they care about. I mean, this is all generalized. There's no secret kind of magic ingredient to the company unless you have one in mind. What I would pay attention to is the first principle of this. Are you actually solving a problem that matters? Do you have the capability and the depth of understanding and the grit to ultimately go and solve it? And do you have the pain tolerance to be able to do so over the next number of years? So, yeah, I mean, take that for what it's worth. I don't know.
I think some of the non-traditional things that people don't think much about is treat your relationships like the gold that they are. The most important currency that gets exchanged is just trust and credibility. So really kind of take these things very, very seriously. The other thing we talked about earlier is that probably one of the most powerful assets that an entrepreneur has is their storytelling ability to talk about the future and get us excited about it. What's interesting is because so many people, we get pitched by so many ideas, it's completely insufficient only to capture our attention. You really have to capture our imagination, and that's a very unique skill that you have to develop along the way. So those are things that, historically we don't talk as much about.
You went into it very briefly about your background, but can you talk more in depth about what your education training was, what you did before being an investor, and your path into it?
Yeah, sure thing. So I started a couple of companies, both as a university student. I mentioned with the coffee shop thing that I got started, but that very quickly led into an e-commerce business that I built that had a moderate exit from it. So I built that over the course of, I think, like my senior and then kind of post-graduation for the next 2 to 3 years. Those were super early stage S&P folks. I raised some capital for the e-commerce company, but relatively minor.
Yeah.
I then went on to build a SaaS company that was focused in the restaurant space, kind of a competitive open table. Raising capital for that ultimately didn't work out. I had a couple of failures. Those are arguably more important in terms of my advice now to entrepreneurs and the learnings. Then I joined early stage fintech in New York. I was there for a number of years. We were focused on the RIA space, both in terms of like direct financial planning software, as well as kind of consulting, succession planning, and a number of like value-added services that tack onto it. And then I went and helped build and grow a nonprofit in Harlem that was focused on essentially providing pro bono services for super low-income entrepreneurs. So less the founders that we're talking about in this session, but like the nail salon owner from the South Bronx. Arguably learned more about being a great partner to entrepreneurs and to some extent an investor from that experience than anything else. And then I was in the process of deciding what I wanted to do next, whether I wanted to start my next company, whether I wanted to go to law school was an idea that I pursued somewhat seriously. I think I dodged that. No offense to anyone in the audience, but it's not for me. And then I met this guy on a rooftop who I had known for years and hadn't seen for years. And he was part of the founding team of Antler in Singapore. I ran into him at a rooftop in New York. It's free coincidence. He started telling me about Antler, and I was kind of like this transition period, deciding what I wanted. And I was like, yeah, man, we go and build this thing. We partnered together. We launched it in New York, and have been here ever since.
Yeah.
One more question, then we're going to kind of wind up, but we'll be here for a little while, so feel free to come up and talk to Ryan, kind of share your story and stuff like that. But we always use these things as a continuing conversation rather than, an hour and a half or whatever kind of bite-sized session. We use these to kind of launch other conversations, so kind of get more involved. Last question.
Yeah, so the 8-week boot camp that you guys run is kind of reminiscent to me of a lot of reality TV, Big Brother and Survivor and stuff like that. And, I don't know how much of these shows you've watched, but they're very cutthroat environment. So I was thinking that there's a possibility that rather than the constructive space, these spaces could, especially if you're competing for limited resources, that founders may undermine each other. How do you prevent that? How do you ensure that the space remains constructive?
Yeah, I hear it all the time. I think that a lot of founders show up day one with that tendency, but they quickly realize that this isn't a Hunger Games, type of situation. There's a few different ways that it just really dissipates. So there's no real advantage to coming into the program and being super cutthroat. It actually isn't this finite resource that you're going after. Again, there's no quota to how many investments are going to make. It's super clear to everyone on day one. It's really about encouraging the right kind of culture over the course of the program, which can be a bit top down, where I can talk about the fact that we don't have this quota or that everyone you potentially have an opportunity to pitch for investment. Everyone just discovers on their own whether they're there for the right reasons. And anyone in the social context that you're talking about who isn't there for the right reasons and wants to compete and not collaborate, they get found out super quickly, which can actually be kind of a valuable way to build culture, is like someone gets ostracized in that way. And you kind of build the culture accordingly. So yeah, within the first 3 days, everyone comes to the realization that this actually is much more collaborative than there's much more value collaborative. So certainly I had it early, it's just never actually materialized in terms of how this thing plays out.
Quite, in fact, often quite the opposite. These programs are actually designed to where you're actually learning so much from each other and the other cohorts that that's the real bond. It's not this kind of bond, it's this kind of bond that kind of helps you. A lot of these relationships last long beyond the 8-week kind of cohort.
They last beyond and agnostic of whether someone got an investment or not. People have gone through the experience and help one another get jobs after the fact. A huge aspect of the program for the folks who decide not to pitch is actually joining one of the portfolio companies that has been hired. That's super, mutually supportive where they're getting a job and working with someone that they're fired up to work with, also for the entrepreneur that receives the investment for them to bring on high quality vetted talent from the pool, or just serves you in your career going forward where you go to the workforce and then people are able to help one another. It's kind of the MBA effect of doing it for startups.
That's a wonderful kind of note to kind of come to the conclusion. Entrepreneurship is a highly social activity. Individuals don't build companies, it's teams that build them, and kind of these relationships are what bring people together. To learn more about the kind of innovation stuff that we're doing here at UCSD beyond these programs, go to innovation.ucsd.edu. You just get a lot of different things. Doug is smiling because he reminded me to make sure to say that, not forget it. Before we did, our entire kind of team and staff at the Office of Innovation is always here to help and act as a concierge to you, make sure that you're getting access to the people and the resources you need. And so if you could join me in thanking Ryan for kind of spending the time and training with us. And hopefully we'll be seeing more of Ryan around here.
Awesome. Thank you guys. I'm happy to be useful beyond this. Antler.co, if anyone's interested in look at it, feel free to add me on LinkedIn. I'll try to be as resourceful as I can. But really appreciate your time. Thanks.
Greg and I are actually building a contact intersection of technology and entrepreneurship right now. We feel like